What is inflation? Find what you should know about inflation. Hey everyone! So, we all know that inflation has surrounded many states and destroyed the lives of poor ones. It is also leading to a boost in the poverty rate of many countries. What should we really do to solve this issue? Let's find out in this video. What is inflation? Inflation is the rate of which prices for goods and services grow over time. It's frequently quantified as an annual percentage increase. Inflation can hugely influence your money, so it's vital to understand how it works and how it might affect you. When inflation is high, it can eat into your purchasing power, meaning that you'll need more money to buy the same goods and services. This can be a problem if your income doesn't keep pace with inflation. On the other hand, if you have debt, high inflation can help you pay it off faster, because your debt will shrink in real terms. Although, you'll still have to make the same monthly payments. Inflation can also have an impact on investments. For example, if you're investing in bonds, high inflation will eat your returns because the fixed interest payments on bonds will be worth less in real terms. On the other hand, if you're investing in stocks, high inflation can be good for business, as companies tend to do better when prices rise. In the long run, inflation is generally bad for savers as it reduces the value of money over time. However, in the short term, inflation can be good for savers as it increases the purchasing power of their savings. How does it happen? Inflation can occur for various reasons, but the most common cause is an increase in the money supply. When there is more money before goods and services, prices will naturally start to rise. This is why central banks attempt to control inflation by manipulating the money supply. Other factors that can contribute to inflation include things like droughts or wars that lead to increases in the prices of basic necessities. The word inflation can really cause a lot of problems. One of the most obvious is that it leads to higher prices for goods and services. This can cause people to cut back on their spending, leading to slower economy growth. If inflation occurs, it can also lead to higher interest rates, which can make it more difficult for people to borrow money. Additionally, inflation can erode the value of savings and investments as the purchasing power of money diminishes. While inflation can have some negative effects, it's important to remember that a little bit of inflation is actually good for the economy. This is because it encourages people to spend money rather than save it. Spending drives economic growth, so a moderate amount of inflation can be beneficial. Of course, too much inflation can be detrimental. This is why central banks work to keep it in check. How can you solve it? There are a number of ways to help solve the problem of inflation. Let us tell you how it's possible. Increase production. First of all, there's increased production, which can help solve inflationary pressures. Increased production can lead to an increase in the supply of goods and services, which can help to reduce prices and wages. Moreover, it can also lead to increased jobs, which can help boost consumer spending and reduce inflationary pressures. Not only this, but increased production also leads to a boost in exports, which can help to improve the country's trade balance and reduce inflationary pressures. Finally, it helps improve the country's overall economic performance, which can help reduce inflationary pressures. Monetary policy. Monetary policy can help to solve inflation in two ways. The first is by slowing the growth of the money supply, which can help to reduce the level of prices. The second is raising interest rates, which can discourage spending and help keep inflation in check. While both of these methods can be effective, they must be used carefully to avoid causing too much economic instability. Inflation can be a difficult problem to solve, but monetary policy can be an effective tool for managing it. By careful use of both interest rates and money supply, central banks can help keep the inflation under control while still allowing the economy to grow. Control money supplies. If the money supply in the economy grows too quickly, it can lead to inflation. One way to help control inflation is by controlling the money supply. There are two main ways to do this. The first is through interest rates. By raising interest rates, the cost of borrowing money goes up, and people are less likely to spend. This can help slow down the economy and prevent inflation. 2. The other way to control the money supply is through quantitative easing. This is when the government creates new money and uses it to buy assets like bonds. This increases the money supply, but it also helps to lower interest rates and boost the economy. Countries with high inflation rates. A number of factors can contribute to high inflation rates in a country. These can include economic instability, high levels of government debt, and currency devaluation. In the first quarter of 2022, Turkey was listed at the top of the countries with the highest increase in inflation at a jaw-dropping rate of 54.8%. Some other countries with high increases in inflation rates include Israel at 29.9%, Japan at 3%, Saudi Arabia at 3.5%, and Indonesia at 4%. Even after a lot of increases in the inflation of these countries, there are some other countries that rank in the top 10 list of countries with high inflation. Let's have a look. Venezuela with an inflation rate of 167%, Sudan with an inflation rate of 192%, Lebanon with an inflation rate of 211%, Syria with an inflation rate of 139%, Suriname with an inflation rate of 63.3%, Zimbabwe with an inflation rate of 60.7%, Argentina with an inflation rate of 51.2%. How does it affect us? Inflation can have a number of negative effects on the economy, such as decreasing purchasing power and eroding the value of savings. It can also lead to higher levels of unemployment as businesses struggle to cope with rising costs. Let's have a sneak peek into the effects of inflation on a country. Retirement plan. Inflation is one of the most important factors to consider when planning for retirement. Why? Because over time, inflation can erode the purchasing power of your savings and investments. In other words, inflation can cause the cost of living to increase faster than the growth of your retirement nest egg. Money bonds. Inflation is the rate at which the prices of goods and services increases over time. The purchasing power of money decreases as inflation goes up. This means that although you may have more money in your bank account, each dollar will be worth less than it was before. Inflation affects different types of investments in different ways. For example, investments like bonds tend to lose value when inflation is high because the fixed payments they offer are worth less in real terms. Poor disproportionately. Inflation affects everyone, but it hits the poor hardest. That's because inflation causes a rise in the cost of living, and the poor spend a greater proportion of their income on essential items such as food and housing. This means they have less money left to save or spend on other things. And that's all for today's video. If the video was helpful, give it a big thumb, and don't forget to hit that subscribe button. Let us know what you think about this increased inflation rate in the comments below. See you in the next video. Till then, take care and bye-bye.